All right. Have you ever thought about doing your own taxes? Or back in the day, you'd go to the um, not the bank, the mail post office, and you would get your forms and you would fill them out by hand. And this was, pre-TurboTax, which is super cheap and you can just put your information in. But a lot of times we used to do our own taxes and calculate them ourselves. And so that's what we're focusing on for this section is taxes, income taxes. So what is income? That's money coming in and you are taxed on that money. That money could be that money could be from winnings of the lottery. That money could be from interest in your accounts, your bank accounts, like at the savings or an investment, any place that you're getting money, that is going to count towards income. Okay. And let's see here. So that's just the percent of whatever's income is collected, right? That's what the government's going to take. So here are some big definitions that you have to know. The first one is your gross income. That is where you add up all of your wages, your tips, your interest. Dividends are money you get from investments. Okay, so you're getting dividends. Unemployment compensation. That unemployment is still you're getting money. Profits from a business, a rental income, or even game show winnings. I'm not sure why it says game show. Any lottery winnings. Okay. Adjusted gross income is where you minus what we call adjustments. Adjustments include untaxed portions of your gross income, such as contributions to certain retirement accounts. So it is basically adjusted gross. You get to take off anything where you were doing a saving for later, some kind of a retirement plan, typically 403b or an IR. No, IRA is not it. 403b is the only one I can think of the name of right now. Did I write it down over here? Um, I don't know why I can't think of any other ones. Anyway, they're usually coming from your paycheck. Your company takes them out and you get to adjust those off your gross income. So it's very small thing that makes an adjusted gross income. Okay. So you minus that one thing off these adjustments. Okay, and then the next big idea is an exemption. An exemption is a fixed amount of money that each person is given. Okay, so on the chart, goodness, it's fine. On the tax chart that they have in your book, which is so not current, they give an exemption of $4,050 per person. So you just get to make that much money and not get taxed on it. So you get to subtract that exemption off. Okay. Standard deduction is similar to exemptions. You either take the standard deduction. So on the form I'm looking at right now, if you're single, it's 6,300. If you're married, filed jointly, it's 12,600. Still 6,300 a person. You add that up, right? If you're unmarried, but you're in charge of someone, so you're a single mom and you have a baby, or um, you are head of household, typically it would be you having a child. You could be taking care of somebody, but elderly rarely count. So I'm not sure. I can only think of children that would actually count. So that deduction's 9,300 according to this form right here. That's the one that goes with your homework. So that's what I'm going to go with. So these are different from each other. This exemption, everybody's given the same amount. Standard deduction depends on how you're um, claiming your taxes. And so you get to subtract two things, both of those off of your income. Okay. And you don't have to be taxed on that. So if I'm just a single lady, I just got to subtract 6,300 and $4,050. So about 10 grand, right? I get to take off my income. Now, what if you don't do the standard deduction? I'll tell you right now, the new tax form that came out a couple years ago, this is what 99.9% of the people do. No more are we itemizing because the standard deduction is so high. I have it over here. Hold on. I should have put it in front of me. Where is the current? So this came into effect in 2020. And the standard deduction is now $12,400. Head of households now $18,650. That's pretty high. So that's just your standard deduction. So I am married, and that's 24,800. That means to itemize, that is interest you pay on your mortgage, interest you pay on your taxes you pay on your property. It is your contributions, your medical that exceeds 7.5% of your income. That's super hard to get to. And the state income taxes. So if I add up all these things that I can itemize, right? Add them all up. Mine have to be bigger than 24,000 for our current tax rate. That's a lot of interest. I do not pay $24,000 a year in mortgages, and we don't pay state tax in Wyoming if you're in Wyoming. So you're not getting that off of there either. So my point is, you're subtracting these two things, and between these two, oops, I'm using the wrong mouse, sorry. You're subtracting off these two things, right? Or you could do this one instead of this one. So let's do a little note on here. It's or. That's one or the other. You can't have both. You either do the standard or you itemize. Okay. Now I used to itemize every single year until 2020. And now I don't itemize anymore. Excuse me, I'm still got a cold. I've made about 10 videos the last couple weeks where I had a cold. Okay. I don't know if that makes complete sense. Hopefully it does as we go through everything. So how are we going to figure out how much income we're going to be taxed? We're going to take that taxable income and subtract our two things. We're going to take our adjusted gross. So we're going to take our gross, subtract our contributions from our our retirement plans. Is it an IRA? No. No, I still can't think of the name. It's an IRA is well, it comes out of your, I don't think this says. Sure. It's all right. Standard deductions. Okay, so let's go through this. So we're going to take that adjusted gross and we're going to subtract off our two things. Okay. So this example says it's a single man. He earned a wage of $46,500. He received this much from an interest from a savings account. Man, that's some good interest. He received 15,000 in winnings from a television game show. Okay, this is obviously an old book. He went to the gambling in Nevada. We're on the reservation and he won because that's where most people win is gambling. And he contributed this much to a tax deferred savings plan. So that's how they refer that is a tax deferred savings plan. He is entitled to a personal exemption of this and a standard deduction of this, which is different from my form. I don't know. They just made up numbers. The interest on this home mortgage was this. Okay, let's start with his gross income. So his gross income is going to be all of his income. So he made $46,500. He also made $1,850 from his savings. He also somehow won $15,000. I wish I won $15,000. And okay, those are all of his incomes. Okay, money coming in. So let's add those up. 46,500, 1850, 15,000. And I get his total income is $63,350. Okay, did he put any money in a retirement plan that was tax deferred? He did. He had 2,300 in a tax deferred. That means he's gonna pay the tax later, tax deferred, okay? So we take $63,350 and we subtract that 2,300 off. Now this is our adjusted gross. 2,300, $61,050. This is where he's at right now. We're almost to how much money he can be taxed on. What are the two things we get to subtract off is our personal exemption and a deduction. So we can look at the standard deduction, right, that they gave. The standard was 5,950, or we can itemize. So to itemize, let's add up all of his contributions. He had a mortgage, property taxes, state taxes, and he gave 3,000 to a charity. So I'm gonna add those all up, 6,500, 2,100, 1,855, 3,000. So I don't have it by hand, I'm too easy, 6,000 plus 21. It probably would have been quicker by hand though. So he contributed $13,455. Which one is better? This one or this one? I'm gonna change the word to bigger. Because I don't want to pay taxes, right? I want to itemize then, and I want this one to be what I subtract off. Okay, so you have to look at that. Should I itemize or should I take the standard deduction? Okay, you have to look at that. So then now I'm at $61,050. That's my adjusted gross. And I'm going to subtract off that standard personal exemption of 3,800. And then I'm going to subtract off the $13,455. So 61050 minus I don't know what I just clicked. Hold on, sorry, 61050 minus this minus 3,800 is $43,795. So what can I be taxed on this? Okay, so this is the taxable income. And people always think this is so hard. No, it's not. You could figure this out on your own. You just have to know the words, and now I've taught them to you. Okay, so maybe make yourself flashcards if this is a hard concept for you, or you're trying to remember what everything is. Okay, so we have a couple more things that come into play. Tax credits we haven't talked about, and then actually calculating out their tax amount. So we have another example here of this lady here, and I'm gonna skip that for now. And if I haven't gone over like too long of a period of time, I'll come back to it. So we want to look at how do we can get that income, right? That taxable income by doing our calculations. But what do we do from there is we're going to use a tax table to determine how much tax you owe based on your taxable income. Tax credits are sum of money that are reduce the income tax owed. So I don't know if you've ever heard of tax credits and things like that. Sometimes you can get them when you have children, and earned income credits, another thing. What it is they actually take money off your taxes. So you calculate your full tax amount, and then it's subtracted off at the very end. So maybe put a note on here, subtracted at the end. Okay. Income tax is going to be your tax compensation minus your tax credits. And that's what that says, subtract it. But I'm saying at the end, just so you remember. So here is our tax. This is from 2016. This is a tax table to help us calculate our tax. The tax rates are called marginal tax rates. So basically you have ranges of income that you have to use, right? So I only pay, like if I'm single, if I only pay 10% of mine up to $9,275. Okay. And then when I go above that, 9,275, right? I'm in 15% tax rate up until this amount here, and then so forth. Okay. I don't know if I have a correct tax rate. No, this does not have the actual tax table. I think the tax table is still really similar to what this is here. But I'm not sure though. I can't remember. So some of these problems, they're just going to give you the taxable income so that it isn't 25 problems all in one. And sometimes it's not. So sometimes you have to take that, add up all his income, subtract off his adjustments, if there are any contributions that are tax deferred, and then subtract your exemptions, pick your deductions, standard or itemized, subtract those. Then you go to this table. So it's kind of time consuming. So we're going to actually calculate this person's tax here on example 3. And it says that they have a gross income adjusted. So let's figure out his total tax, taxable income. So gross, we have $62,000. That's all the money he made off of wherever he made it from. And we have to subtract off this 4,000. That's going to get our adjusted gross, right? So 58,000. Okay. And then from there, I got to decide my deductions. They give us itemized, right? So they give us itemized. Can you take that medical though? I don't know if they care. So let's stop and think about this medical contribution. I don't, he, when you have something big medical wise, you are meeting your deductible, which sometimes in some people's plan is 5 grand. So all what you pay is what the medical expenses are. Sometimes people think like, I I went and had surgery and it was 30,000. Yeah, but what did you pay? Okay, did you pay 5 grand of that? Did you pay 2,000 of that? Did you pay none of that? This is all based off that. You have to take your income, and it has to be bigger than, I think it's 10% now, not 7.5, which is what the book kind of says. But let's say I was at $58,000 and I times that by, I'll use the 7.075, right? Then I would have had to pay more than 4,320 or $50. I know it's backward, but you get my idea. So this medical here is not, I can't claim that. It isn't enough money. So I'm a cancer survivor. I paid $30,000 to $40,000 out of pocket between the 2 years because I got sick, crossed over December to January before I finished chemo and radiation. So I had some in 1 year and some in the next. So with my deductible max out of pocket, I still did not qualify because one was in 1 year, one was in the other. So I paid, I don't know, 1 year was more than the other. I think I paid like 10 grand 1 year and it still wasn't enough to claim it because it was 10% of your income. So you have to make kind of a lot of money. Um, I mean, not, you have to make not a lot of money. I said that backward. All right, so let's look at this. Let's be realistic and say can't use. I don't think, be careful of that in your homework, but I think that they will say you can use it maybe. I don't know. They shouldn't. Okay, so then let's take this 58,000 and let's subtract off our standard exemption is this. So 4,050, and then I'm going to subtract off either the standard, and this person is a woman, no dependents. Woman, no dependents. So we're still in the single category. And her standard deduction is 6,300. Well, I can see her mortgage interest is 7,000. She must have a huge mortgage. So I'm going to add 7,500, 2,200, and 2,400. So I added 7,500 plus 2,200 plus 2,400, and I get $12,100. I'm going to leave off the 1,500 because sorry, lady, you made too much money. Can't claim that. And I'm going to subtract that amount because isn't that bigger than 6,300 up here? Yeah, that's way better. So we subtract our two things off. So 58,000 minus $4,050 minus 12,100. And I get a taxable income of 41,850. Okay, so 41,850. From here, this is now what I'm going to use on this table. That's my income I can tax. Tax credit comes later, so we're going to wait for that. So I'm going to go up here. I am using this first row because that's for single people. So on my 10% row, I am going to think of that as 0.1 for 10% times 9,275 because I'm above 9,275. I know that I'm ending in this category here. So I maxed out the 10%. So what is 10%? It is $927.50. And this is all tax. So I'm going to pay $927.50 off that first category. Okay, isn't that pretty? So the second category, 15%, I've already paid taxes on $9,275 of my income. Now I'm going to max out this category, right? So how much money is really between these two? So I'm going to take, do it. Maybe I'll put it down here or something, looking at that 15%. I didn't know where to write it. So 37,650. Sorry. And I'm going to subtract off 9,275. Don't use the 76. Don't use these numbers. Your book wrote those to try to be helpful. And that's actually not even how the tax rate goes. Those aren't there. And it's just to show you like, oh, $1 more and you're in this category, but you really pay taxes on 9,275. If you use the 6, you're off like this 1 cent or so, and you're going to get frustrated in your homework and not get anything correct. 37,650 minus 9,275. So really there's $28,375 in that category. And we were above, our taxable income is 40,000. So we're above that. So we are going to pay taxes on 15%, on 28,375. So 28, I'm gonna times that by 15%. That's gonna bring in $4,256.25. Ooh, there's a decimal there. Sorry, my I wrote too big on the 15%, can't fit it all over there. Okay. Now the next category, looking at that 25%, I am not maxing this out. I'm not going to 91,000. I'm going to 41,000. So here's what I do. I take my 41,850 and I minus off my what? 37,650, because I've already paid taxes on, I've already calculated my tax on $37,650. I've already calculated that tax. So just the amount of money above 37,650. That's what I need to know. So 41,850 minus 37,650 is 4,200. So I only have in my 25% category, I only have 4,200 more dollars that I pay a higher tax bracket on. So you hear people say, I don't want to make above this amount because I go to a higher tax bracket. That this is what they mean. Like I'm bouncing to the next category. Okay, what is 25% of that? Around 1,000, yeah, $1,050. So now I'm gonna add these up. So 1,050 plus $4,256.25 plus $927.50. My tax that I have to pay is $623,375. So I pay the government $6,233.75. Oh, and this is only federal tax. We haven't even looked at state or FICA, which FICA is your like social security tax and stuff. Federal tax takes us a lot of time. Okay, one last thing. Did we have a tax credit? Yes. So we get to minus $500 from this. So 5,733.75. That is our tax, final tax. Ooh, so tax credits are kind of cool because they come off at the end. And that's what the earned income credit is as well. If you haven't heard of that, it is made to help people who make lower income and be like rewarded for actually having a job. So they actually will get money back that they never paid in, basically. Because like the earned income credit. So like for this is current. I'm reading current tax information. Your income, if you make less than $7,030 and you have no children, you qualify for earned income. If you make less than 10,000 with one child, or is it more? Or around 10,000 max credit, one child. Yeah, that's where your credit begins because it's if you make less than that, you haven't earned the credit, I think is the way it works or something like that. And you have child tax credits. Those are really nice. You get 2,000 per qualifying child. So you get actual tax credits for your children as well. I can't think of like, yeah, if I have 3 or more children, which I have 3, phase out. So I start to earn the earned income credit, a certain percent at 14,800. I have to make at least $14,000 with my 3 children as a single mom. And I can't go above 50,000 or I don't earn that earned income credit. So I got the earned income credit when I started teaching because the pay was super high. I had a little girl. She's not little anymore. Okay. Oh my gosh, that was a lot. Use the tax rate. So I'm gonna skip the other question. What I'll probably do is have a second video with like another example, just because I don't want your main video to be an hour and a half. Okay, so Social Security and Medicare is FICA. So this is a straight amount percent that you have to pay, and you have to pay this regardless. So you don't get this back. Five 5.65% on your first this, and then it goes down. So this is employees rate. So employees pay that. Employer pays this, and self-employed rates. Okay. All right. So, oops. Maybe I'll pause here and I'll do FICA in a separate video. So what I want you to do is pause yourself and go try a couple with this tax and just finding your taxable income from the homework. And then we'll do the second part. So there'll be a part 2.